Welcome to our town hall for the fifth time, I believe, Apollo. Is that right?
Yeah,
maybe?
that is about right.
Number 5, I believe.
Yep.
And
I've been counting. Yeah.
yeah. And speaking of counting, this is Dimensional's 40th anniversary, believe it or not. Incredible. Back in 1981, David Booth came up with this idea to start this company based on small caps. And Chris Edgar, who is our regional director, volunteered to give a little history and a little congratulations to Dimensional and to David Booth. So Chris, why don't we start off with you talking about the history of Dimensional?
Sure. Well, thanks, Mark. And, many of you who have been part of these conversations with us over the last year or so may have seen my name. I tend to operate in the background with my colleague, Kenny Morgan, who's on here as well. But given the special occasion, our 40th birthday, which in fact was yesterday, Mark thought it might be a nice little thing just to tell you a little bit about our journey. And I feel like a quote from Dimensional's founder and chairman, David Booth, is only fitting in this situation. So David has said, "We built the firm on the foundation of implementing the great ideas in finance. And for 40 years, we have trusted markets. For 40 years, we have built trust with financial professionals and investors around the world. Today, more than half of wealth held in mutual funds and ETFs is in index funds. And Dimensional has grown to more than 600 billion in assets under management, largely through word of mouth and the growth of our clients like IFA. As an industry, we've made incredible progress driving down costs, encouraging diversification, and developing innovative solutions that benefit investors. These advances have been profound for investors, and I believe it's just the beginning." So that's the quote from David Booth. And what I would just like to say is I couldn't be prouder of an organization, and I have felt fortunate to call Dimensional a home for over 13 years now. In the last three or 4 years, I've worked really closely with Mark and the IFA team. And Mark, correct me if I'm wrong, but you've been with us now, working with us closely for about 22 years, right?
That's right. 22 years.
That's incredible.
Yeah. 1999.
1999. Yeah, I was finishing high school in 1999. Well, what I'd like to say just real quickly before I turn it over to Mark and Apollo for this Q1 town hall that we have scheduled here is that I just think it's been an incredible experience, these 40 years with Dimensional and my last 13 years. And like David Booth says, I believe it's just the beginning. I couldn't agree more with that. So I just want to say thank you to everyone on this call for joining us in this journey. We feel very fortunate to be able to work closely with you. All right, Mark and Apollo, that's what I wanted to say.
Yeah.
How was that?
That was wonderful. Thank you, Chris. I just have to say that it's been an incredible journey for me as well. I think the first time I showed up at one of the conferences, I think Dimensional might have had 26 billion, maybe 28 billion, maybe something in that ballpark. Right. And even then, that was very impressive to me. And so to watch you grow as I've grown, it's really been a joy and an intellectual journey, I must say, learning all of this incredible research from the academics. And with my background in nuclear pharmacy, I was immediately attracted to this academic approach because in nuclear medicine, we had a journal of nuclear medicine, and I was shocked to find out there was a journal of finance. Wow. And the articles in there looked like the medical articles that I had been reading. And I said, this is really for me. And I think it's really for everybody. They just don't really have a good comprehension of all the empirical research, really, and all the data that goes into creating these investment strategies. So I'm proud to be a part of what you guys are doing. And just to make it clear one more time, we are completely independent of each other. There's no money that goes between us. We just happen to have a common mission in giving investors a better investing experience and really helping them do better. So Apollo Lupescu is a vice president over there at Dimensional, and he's the secretary of explaining stuff. And for those of you who are new, this is our 5th town hall discussion that we have done, helping our clients and taking questions from our clients. So it's sort of an interactive live program. And so, but we're going to also record this so you can review it later. And then we add a few little goodies into the recording. Apollo does a lot of these talks, and he's really honed his skills in explaining stuff. And so why don't we get started, Apollo, with you kind of talking about the performance over this last quarter.
Yeah, well, it's great to be back. And again, thanks for the invitation. Thanks to everybody for attending. And Mark, to kind of finish this whole up, thank you for the partnership. There's no material, there's no financial connection, but the fact that you entrusted your clients' assets with Dimensional really means a lot. And every single day, we don't ever want to forget that we want to do the right thing for the client, the same way that you do for your client. That's kind of our job as well. So let's start with the numbers.
Yeah.
How did the market do? And one of the things that we talked about is that when we talk about a portfolio performance, the first thing we have to acknowledge is there are two very different types of asset classes. And in fact, all the portfolios that you have on your website are broken up based on this consideration. On one hand, you have ownership into company. The equity ownership comes from stocks. And then you have the lending, which comes from bonds. So we're going to separate these two because stocks and bonds did quite differently the past quarter. And let's start with the equity piece, the ownership. And let's look at how stocks did. And here, I'm not going to be overly precise. I want to make sure that I kind of disclose out there. These are just some rough numbers because we'll talk about why is it hard to hone in on your individual performance. But when you look at stocks for Q1 2021, in general, we talk about stocks market from a global perspective. What you would have seen that stocks did pretty well. And if you look at an index like MSCI All Country World Index, you would have seen a performance of about 5%. That's kind of how the market did in the first quarter, not for the year, just the first quarter, which was a very good quarter. In the U.S., if you look at the S&P 500, which is a broad measure of the large companies in the U.S., that was up roughly about 6%, so a little bit more than the global stocks as a whole. So if we unpack now, and we ask, well, why did we see 5% versus the 6%? Well, in a diversified portfolio like IFA has, there is certainly a portion of U.S. companies. And for the U.S. portion of the portfolio, the performance of the market as a whole, these 3,000 companies that you can buy and sell in the U.S., was roughly about 6%. As a whole. International developed countries like Australia, Japan, France, and so forth, as a whole, all these 22 countries had a performance of about 4%, a little bit below the US, and emerging markets had a little bit lower at about 3%. Again, these are rough numbers based on indices, and that's kind of what we see for the quarter. But I also want to highlight one more thing. We just went through a terrible, it was a very, very bad year for humans. We had the pandemic, but it turns out the markets for the past year have been actually quite rewarding for folks who had the discipline to participate in the market. And if you look at the U.S. market as a whole, in a year, a 1 year ending at the end of March, what you would have seen is there was up an incredible 63%. International developed was up about 48%. These are rough numbers based on the global indices, and emerging markets were up very close to the US at about 61%. So the 1 year numbers are remarkable, but in order for investors to capture these fantastic 1 year numbers, I think the biggest prerequisite was to have an advisor who has a disciplined long-term approach to investing. And that really paid off in spades over the past year. So we'd be remiss not to kind of really talk about that really important piece. It's not just the numbers, but the fact that you took part in them, and that was because of the discipline that IFA brought to the process. Now, within these international, developed, emerging, and in the U.S., when you combine them all, there are over 40 different stock markets to which you had exposure. And when you look at these 40 stock markets, it might be tempted to believe that the US was the best performing market, but in fact, it wasn't. On the international developed side, just so in curious, if anybody asked you at a cocktail party, what was the best performing stock market among international developed? Well, a little trivia. I wish we had a drum noise there, but it was the Netherlands. The Netherlands was up about 18.8%, almost 12%, so almost twice as much as the US. And then right below it was Austria. The worst performers around international developed were Denmark and New Zealand, both with negative returns for the quarter. Emerging markets, that's where you had the high flyers. The two biggest high flyers among these 40 plus different stock markets, one was Saudi Arabia. It was up about 15.8%, almost 16% for the quarter. And then right next to it was Chile at 15.5. Those are the best performing countries in the world. And you had them as part of the exposure to a global portfolio. And then on the bottom half, we had Colombia and Turkey. So just a quick overview, very, very diversified portfolio. And the performance that you had obviously depended not only on the discipline, but the allocation that you had to different parts of the market. And as kind of, Mark has been talking over and over, it's quite random from quarter to quarter. Last year, there were quarters when emerging markets did a lot better than the US. This is a situation when the US did better. So it's random, and it's not really something that you can predict. But if you actually take one finer, deeper look among these 40 different stock markets, what you actually had and where this comes from, these results actually come from the performance of individual companies. And in this case, a globally diversified portfolio might have had upwards of 13,000 different companies in which you had exposure. So really a very, very well diversified portfolio. And then to kind of wrap it up, among these 13,000, we know that not all companies are the same. And the research that Mark alluded to kind of give us a little bit of a hint of what we have seen over the past quarter. And if you delineate based on large companies, this would be something you would see, let's say, in the S&P 500. From the smaller companies, their performance was not exactly the same. These large companies, as I said, they're up about 6%. The smaller companies for the quarter in Q1 this year, they're up about 16%. So significantly bigger growth in small companies. So this is what we call the small cap premium, which certainly showed up over the past quarter. And it's not just the past quarter. In fact, if you look over the past year, what you see is that the large companies went up, as I said, about 61%. And what's fascinating is large companies went up a whopping 106%, doubled over the past 12 months. A remarkable performance that we saw in small companies, and that's the premium that we've all been waiting for. It's kind of coming, and finally it showed up for the past quarter and the past year. And then if we further break down based on not only large and small, but also value and growth, just to give you a perspective, for the quarter, large value was up about 8%. Growth was actually flat, 0%. The small value was up 23%, and small growth was up 9%. And then just to kind of give you, once again, a perspective, not just over the quarter, but the year, this was 60% up in large value, about 63% in large growth. But look at small value. It was up 116% and 97% for small growth. So certainly, Mark, it was a very good, very rewarding quarter for investors who are disciplined, but also in terms of the tilts towards small and value, this was something that paid off. And as you said, we've been waiting for this. Nobody knows exactly when it shows up, and that's why discipline is so important.
Yeah, we saw some of this in the recovery of 2009 as well. It's interesting. Yeah. So I think some of this might be related to recovery, but But the randomness is we don't know when the recovery was going to happen, right?
Yep.
People could forecast it. And even the forecast of a recovery, which I think started, at the bottom of COVID, was already being built into prices. And so, but you know what, Apollo, this brings up one of the questions that we had submitted in advance, which had to do with somebody's concern about sticking with, there's globally diversified small value portfolio over this kind of dry spell where, they thought, man, I could have just been in that S&P 500 and been better off, right?
Right.
So,
Right.
How would you address that question?
Yeah, no, and it's such an important question because when what we have right now is companies and particularly like the large growth stocks, they have been driving the market quite tremendously over the past few months, and in fact the past year was particularly remarkable.
Yeah.
And just to kind of share some numbers, if you go back to 2020 and you talk about these large tech stocks, last year the market, the S&P was up about 18%. Which is a really remarkable performance given everything that happened. But if you look at the largest 5 holdings, which amount to more than 20% of the value and account for more than 20% of the value and the performance of the S&P index, and that's the big tech that we talked about: Apple, Amazon, Microsoft, Google, and Facebook. On average, between the 5 of them, they had a remarkable almost 50% return, 49.3% return on average between the 5 of them. And certainly when you look at small value, it really trailed relative to both the market and these large top 5 companies in the market by capitalization. So the question is, how did we do this quarter? Is it something that we should expect to happen systematically going forward? And the answer is not necessarily. And I'll give you the short-term answer. If you look at what happened this Q1, the market was up about 6%, and so were on average these 5 companies. So they just barely did just what the market did. But then look at small value. It just absolutely crushed it. It had a much, much better performance. So it is important to have some of these large companies. They are part of the S&P, but it's also hugely important to diversify. And if I could actually do a little exercise there, Mark, if an investor sees these numbers, you look at these numbers and you say, well, the market did 18%, these stocks did over 49%, and you have these little Cinderella of stocks that are the small value. Well, as an investor, where would you want to invest your money? I mean, it's like if you saw these numbers, I think a lot of folks understandably would be drawn towards these large 5 companies. And in fact, this is not the first time that we see something like this. We can go back to just about 20 years ago when we had a very similar situation. We had very, very large, well-established companies like Microsoft. Every computer was running Windows. You had GE making anywhere from airplane parts to turbines to managing money. Yep. Cisco powered the internet. Walmart, the largest retailer. ExxonMobil, like 90 years of dominance in energy. What could go wrong? And not only that, if you look in 1999, these 5 companies on average had a return of about 67%. Not far from the 49% that we saw past year with these top 5 stocks. And further, that year, the market was up 21%, similar to the 18, roughly in the ballpark. And small value, once again, trailed badly. It was a negative for the year. And once again, if you saw these returns back then, and you said, well, where should I put my money? I think most people understandably would say, well, these are really solid, big companies. And what can go wrong? Well, if you fast forward an entire decade, what you see is that on average, these 5 companies actually had a negative outcome, a negative total return over 10 years. And so did the market. They did a little bit worse than the market. But what's remarkable is that Cinderella, as I said, the little nugget out there that didn't look very good in 1999 really had a good role in the portfolio over the next decade. And if you fast forward another decade, you look 20 years now, you see that these companies did come back, but not as much as the market, and certainly not as much as small value. And the point here is not to argue that, it's not to suggest that these companies are going to go down in flames. I have no idea. The point is not to just put all the money in small value. the point is it absolutely makes sense to stay disciplined and be diversified. That's the big story: being diversified and not losing the discipline when a handful of stocks might be doing really well. I think that's an important lesson to me.
I think that's so important, Apollo, and it reminds me of what Kim French said not too long ago, is that what we've been experiencing are unexpected returns, okay? Right. And you can't keep expecting unexpected returns. Right. I love that line. And when you want to arrive at an expected return, then you can't be looking at these little windows of time that are even 10 years long. You've got to go to all the long-term data, which is this table that DFA has created and updated for us. And we just updated it here for 2020. And then you see some little more sobering and not such huge differences in returns like you've been just showing, but still substantial differences of a small cap premium here in the US of about 2% per year. And you were just, what was that, 100% or something? It was crazy for the one 12-month period. And so those are unexpected returns. And what's difficult for investors is appreciating how long you have to wait to get the expected. And because you can be either side of this bell-shaped curve of returns. The returns look like a normal distribution, and for monthly returns anyway. And so you can easily get returns on either side of those tails, and they can skew your results, your actual realized returns, for extended periods of time, much longer than the average investor has in their mind.
Yep. And to that point, Mark, it's so remarkable how quickly things can turn and how big these premiums can be. And quite often, if investors don't have the discipline, and that's kind of one of the main issues that I find for investors not having an advisor like you, is that quite often there's a temptation to kind of give up on the system and lose the diversification and perhaps at the wrong time, because as these big returns show up, you have to be in your seat to capture them. And that's why I think it's absolutely crucial to have a consistent discipline approach to investing.
It really is. And I just want to support that with another chart, Apollo. This is looking at the returns of small cap stocks over a 20-year period. And there's 5,000 trading days in that 20-year period. Right. And if you just missed 5 days out of the 5,035 days, your gain on your investment, okay, you start off with 10,000 and you have a gain, right? The gain on your investment drops 37%. And if you lost 20 days in 20 years, 1 day a year, this is why it's so important to stick with the program and stay in your seat. You lose 86% by just losing an average of one good day per year invested in small caps. So this is incredible data. And every time people really absorb this and it really starts to hit home with them, then they get it. They start to get it anyway, that they cannot be jumping in and out of markets and capture those long-term returns.
And there's one more thing that you and I have been talking, for quite a while, and it's this idea of how do you go and capture those? Because one way to do that, and I think generally speaking, the broad name of the funds that do that is called index funds. And the index funds in general, that's what they're trying to do, is be disciplined and capture a broad asset class. Now, even within index funds, there are different distinctions. Not all funds that fit in this category that generally are called index funds are the same. So you have some funds that are created by commercial entities like a Russell committee, or you have the S&P committee, or you have you name it.
Some indexes.
The conventional traditional index, which is basically, it's about licensing a third-party list, and that list gets replicated into a mutual fund. And that's one way of thinking about index funds. And I know then in our perspective, index funds is similar in the sense that you want to be broadly diversified, but instead of going to a commercial benchmark and licensing the list of stocks, which is not a horrible way to do it, you are leaving some money on the table, because what happens is that, like in the case of Dimensional, we don't license it from anybody else. It's a custom design list, but that allows us to also have a lot more consistency. When you talk about small company stocks, and we saw this even at the end of last year, was a great story with GameStop. You have these small company stocks that all of a sudden, over a short period of time, they could really jump up in price. And instead of being a small company, they become all of a sudden a large company. So what do you do then? In the conventional index, they would maybe wait another few months until the index gets around to what's called reconstitution, which is figure out what's small and what's large. But that could be a while. What we're trying to do is kind of the same idea, deliver small cap, but do a lot more, have a lot more consistency and precision, and look every single day to see what's small and what's large. So part of what you just showed there is also you can get it better than a commercial benchmark if you are more precise on small caps every single day, always paying attention rather than doing it once a year.
Yeah, so this is what I generally call trading strategies of managing a passive portfolio. And Dimensional, David Booth was there when the very first index fund was created at Wells Fargo Bank. And so he's been around this forever. And so he's learned the refinements of managing passive investments to improve the returns through the reduction of market impact costs, through the consistency of risk over time. I tell clients we rebalance their portfolio for risk maintenance. Well, you're doing that on a daily basis. We do it, when the opportunity arises. But what you're really doing is really maintaining that risk by keeping the portfolio at a very consistent exposure to a certain level of small companies, which happens to be about half the size on average of a small cap fund from Vanguard, for example. So there are different indexes. And in fact, 22 years ago, when I started this, that was one of the first things that kind of hit me like a ton of bricks. Oh my gosh, there's all kinds of indexes out there. And then I also realized that, that was the only thing that made sense, is to invest passively. And in the future, it's going to be a question of what indexes and in what proportion that investors should hold these, and at what risk level of those combinations, mostly stocks and bonds, controlling that risk level. So anyway, all right.
Yeah, and if Mark, maybe for the audience, just to make it real, because a lot of this we talk about an app store. Let's just give a case study and look at what happened in reality. So I think that what we mentioned, the GameStop is a good example because so many people have heard of it. At the beginning of the year, it was about $18, $20 per share, and it kind of stayed there for a while. And then all of a sudden, you had the Reddit community, and you had all these folks piling in. And I'm not here to tell you why the price went up, but what we saw is a significant increase in price. And whenever you see this significant increase in price, what means that the company's value also significantly changes. So if at this point, this company maybe was part of the small company universe, the small cap universe, as the price went all the way up here, well, it really jumped up. And it's, when it hit the peak, the value, what's called capitalization, which is how many shares does the company have out there in the market, multiplied by the times per share, that's what capitalization is, was 24 billion. And to give a sense of what does it mean, 24 billion? Well, it was larger than 200 constituents in the S&P 500. And if you want to get a perspective, it was as large as Whirlpool and American Airlines combined. This is GameStop. So at this point, as a small cap manager, what you see is that this stock was part of the small company universe when he was here. But as the price skyrocketed in a short time, then at some point you had, you had to look and see, well, this is no longer a small company. So if I want to retain this small company portfolio, then what I need to do is consider selling it. And beyond that, there are other criteria that have to do with profitability and so forth. So what Dimensional ended up doing is actually, let's just take a step back. Around this time, we had about 3 million shares in the different portfolios, and it was definitely in the small cap universe. That was like the beginning of the year, worth about $60 million in GameStop at the beginning of the year. As it crossed these threshold and it moved from being in the small cap universe to the large cap universe, as some of these profitability criteria kicked in, and it wasn't really a profitable company. By the beginning of February, we ended up selling the entire position in GameStop. And that was the result of this consistent, systematic process. And what it actually meant for investors is that the 60 million at the beginning of the year ended up, when you look at all the positions across all the funds that were liquidated, turned out into about $1 billion for investors. Now, I wish you can do this for every stock. Take 60 million, turn into $1 billion in about a month. But the reality is that what we're saying is, and it's the consistent, disciplined approach. And you touched on that. You need to have it. You need to have that consistency of small, because otherwise, if you're in a typical index fund, they would have written this. They would have gone all the way up here and then all the way down here, because even today, GameStop could still be in some of these commercial indices.
Absolutely. Absolutely. Well, listen, we have about 4 or 5 major topics here we still want to get to. And so are you done with your review? Are you
yes,
pretty much
let's just move on. Yes.
Let's get to some of these questions that were submitted by our viewers. The first one has to do with inflation. We hear that a lot today. And give us your thoughts on the possibility of inflation in the future, but also the likelihood that inflation is already priced into securities.
Yeah. So let's start with just inflation in general, because it's being put out there as the boogeyman that like, oh, you could be really scared of this. This is terrible. It's horrific. Let's just start with the very, very fundamentals. Inflation is the tendency of prices to change from year to year and go up from year to year. And inflation is not something really new. We have had inflation for many, many years. In fact, for a very, very long time. And on average per year, this rate of inflation has been about 3%. And what it means is that on average, over the long run, if something costs $100 today, well, if it goes at 3% inflation, it would cost about $103 a year from now. And this 3% rate is again, it's in line almost with what the Federal Reserve itself desires inflation to be. The Fed stated that 2% inflation is desirable. So anywhere between 2 to 3%, it's nothing really horrific. And in fact, it is desirable. We need prices to go up, for companies, because they have debt to repay, and so there's a natural thing, and it's a desirable thing for prices to go up. The opposite of pricing going up, it's called deflation, and I'll share with you in a minute that was a concern at some point. And in fact, for many countries, deflation is probably of greater concern than inflation. We know better how to deal with inflation than we know how to deal with deflation. Japan had that issue for many, many years, and they're still trying to sort it out. So in other words, inflation in a particular range, there's nothing really horrific about it. Now, the recent conversations around inflation have been triggered by the stimulus package. And this idea that the government is spending a lot of money and that will cause prices to go up. And this idea of the government putting money in the economy is nothing really new. Mark, remember about you brought up 08, 09. After that financial crisis, there was a stimulus from the government, not as big as this one, but we also had something else. We had the Federal Reserve put in place programs called quantitative easing. And it came in like quantitative easing 1, the first stage, stage 2, quantitative easing 3. You might have known as a QE, quantitative easing. That was the acronym that was used. And it was trillions of dollars that were basically put in the economy by the Fed through purchasing securities with the idea of stimulating the economy. And very similar question. Remember, Mark, a lot of folks are really concerned. Well, surely all these trillions of dollars will lead to some inflation and big inflation. And about exactly 10 years ago, that was a big question on investors' minds. And what's fascinating is that since then, on average, with all these trillions in the economy through the quantitative easing, the average rate of inflation since then has been roughly around 1.5%. Half the historical rate and below the Fed's desired rate. So how is it that with all these trillions, we actually didn't see as much inflation as people had expected? And to me, as an economist, when I think about it, there are two sides to the inflation story. The first one is how much money is in the economy, but there's another story that has to do with the economy's ability to produce. And let's just once again make it real. Let's say that I'm a pen manufacturer. I make pens, and I have certain orders that come in. I make the pens, ship them out. Everybody's happy. Now, because of all these additional dollar bills, I now get more orders. Here's the thing. If I have the capacity to produce the additional pens, I can hire the workers, I can buy the materials, I produce the pens, ship them out. I don't have to raise prices. And that's what it seems to have happened in the economy, that we had the capacity to produce without raising prices. On the other hand, if I don't have the capacity to produce, then I have to raise prices so I can restore some balance with the orders. So a big part of what economists are looking at when it comes to inflation is not just the demand side and what the consumers have, but what is the economy's ability to produce. And in that respect, what most economists are telling, and I'll show you what is signaled by the markets, is there's an expectation that over the short run, while we still have coronavirus protocols, while we still have, some of the trade wars and some of the supply constraints around the world, in the short run, the economy will be more hamstrung, and perhaps prices will grow a little bit more than they have in the past. And the question is, how much more, how big is this inflation? And to me, rather than kind of give you my peanut gallery opinion or to kind of point you, look at what the one person says, I have a better way. And I suggest all of you would probably want to check this on a more regular basis if you're interested in inflation. There is a way in which investors, these are professionals, Harvard MBAs and Stanford PhDs, that every single day are looking at all this data. The market, what we call the market, is looking at the expectation of the stimulus and what it will do, and maybe the infrastructure. All of these are known to the market participants. And there is a way in which they don't write opinion pieces, but they rather vote with billions and billions and billions of dollars every single day. And that is in the way that they invest in certain kinds of bonds. There's some bonds that are inflation protected and some funds that are not, which are called nominal. And when you look at these two types of bonds, in fact, the Federal Reserve and economists all over the world can kind of infer something that we call a break-even inflation rate. And what is the break-even inflation rate? The break-even inflation rate, basically, it's a big term, but you can go down on this page that is published by the Federal Reserve out of St. Louis. And it tells you what it means. The latest value implies what market participants expect inflation to be in the next 5 years on average. So this is not one person's opinion. It's a combined wisdom of the market. And what you see is over the past 5 years or so, the rates have been about 1.5%, a little below, a little above, but just in a 1.5% to 2%. Then they went up a little bit, and below just around 2%. And as the pandemic struck, we actually had the opposite concern. Yeah. Deflation, no increase in prices. But then as the stimulus came in, the economy came back to life. With all this information, right now, where we are, it is higher than we've been in the past. It is higher than we've been in the past few years, maybe the last 5 years, but not by a lot. what we see right now that over the next 5 years, the market expects inflation to be about 2.5%. So it's a little bit higher, but certainly in the range that is not catastrophic. It's not
below the long-term average of 3.
Exactly, it's still below, and this is the short-term average, Mark, because if from the same break-even inflation, what you see is that the market expects 5 to 10 years from now, the rates will actually drop below 2%. So there's a short term until these supply issues are ironed out, until we get back to some sort of normal. But beyond that, once again, we're going to go back to the to what the Fed target might be. And to me, what's interesting is that if you go back even beyond the last 5 years and you go as far as the data has it, we kind of see right here that we are still not close to even what we were in 05, and we're not even like at that level. One example that kind of stuck with me is we're talking yesterday. I have some neighbors that moved in 9 months ago, and God bless, great people, but they've been in construction forever. I'm kind of getting really tired. I think we're really lucky today because they're not jackhammering or some other crazy thing they're doing. But I do know that when they started, and I was talking to them not too long ago, when they started, a piece of 2x4, which is wood used in construction, cost about $3. As of a few days ago, they told me they were paying $7, and they investigated, why am I paying more than twice as much for wood? Is it that so many people are doing construction? And the answer is no. Apparently, it is the Canadian lumber mills that are having issues because of coronavirus and what's going on with the trade and everything. And that is the primary reason for the increasing price. So nothing to do with the stimulus. It's, again, these short-term pains around still living in a world with coronavirus. So it was a long-winded answer, but Mark, ultimately what I like perhaps to convey to your folks, inflation by and large is not something horrific. It's something that to some degree is desirable if it's in certain ranges. The market, and we are big believers in markets, what they're suggesting right now in the way that investors price assets is that inflation will be a little bit higher over the next 5 years, but totally within a really reasonable range.
These fears of inflation and greed that you might hear in the financial media, fear and greed both, are all part of the financial media infomercial. This is basically a big infomercial for all these brokerage firms who sponsor this financial media, who put up the ad money so that it exists. And I would say 98%, maybe 99% of it is to get you to trade, to get you to call your broker who are sponsoring these programs, who are showing up on these programs, to give their opinions. And of course, who's keeping track of those opinions to see how well they do? Oh, we do, and CXO Advisory does. And on average, they're really bad, but nobody really checks this. And so I just want you to kind of pull back a little bit when you hear people making these inflammatory statements about what's coming and how you should duck or dodge or do this or do that. Because first of all, as soon as that information is known, it's rapidly incorporated into prices, and therefore it's useless after that. Okay. So most of what you hear has already been embedded in price and therefore has negative information to you. I was going to say it has no information, but it's actually negative if it gets you to move based on something that's already been priced in.
Yep. And so, and once again, the other thing that's kind of, I wouldn't say priced in exactly the same sense, but the one thing that was taken into account is the fact that when this happens, you have a plan, you have an allocation that was built to withstand whatever might be coming and make sure that you achieve your financial goals. So yes. The plan is there. It's like, this is not something that's taken anybody by surprise. Oh, we need to make this big. No, we kind of, we have a portfolio that the way it's put together, it's really built to withstand. It's not some sort of like, remember the good old Discovery Channel planes. There are like all these beautifully stringed airplanes that were just so beautiful, but so delicate. One string broke and the whole thing crashed and burned. That ain't it. This is a tank. This was built to go through things. So.
Well, yeah. Okay. So someone else commented that the market's kind of has a high PE at the moment.
Yeah.
And what do we do? What do we buy now in that environment? Apollo, what to buy now?
Right.
So caution, this is not CNBC. All right.
Right.
So go ahead.
So I think there are different ways in which you can look at the market, and I think that just for folks, PE refers to this idea of price earnings, which is how much do you buy, how much do you pay to buy $1 of earnings? Let's say there's an investor say, I'd like to buy $1 of earnings from a company. How much does it cost you? If it's a high PE, highest price to earnings, that means you're paying a high price for that dollar. And I can give an example right now, and this is actually maybe it's a little outdated. Last time I checked, if you wanted to buy $1 of earnings in let's say Apple, it would have been, or let's say Pfizer, it would have been, I think it was $20 to $30. And that buys you $1 in Pfizer earnings, who makes the vaccines. $1 in Apple was $30 to $40. $1 in Amazon was anywhere from $70 to $90. And $1 of earnings in Tesla would cost you over $1,000. So really, when we're talking about price earnings, it's one way to see, well, what's a good deal in investing and how expensive things are. So if they go up, then obviously the market is the prices in the market go up. But what's interesting is that instead of looking at earnings, the other thing that you can look at is how much an investor pays for something called book value, which means that as an investor, I buy, the value of a company can also be ascertained as the asset that it owns minus the liabilities. And what's left after liabilities are paid, those assets are called book value. So you can see it's an alternative metric to price earnings that tends to be a little bit more stable because earnings can fluctuate quite a bit where book value tends to stay. And we have looked at exactly that issue that you point out. How expensive is the market? And rather than looking at the market as a whole, perhaps a better way is to distinguish between these two asset classes that Mark has been and the IFA has been utilizing for a while, value and growth. Because value reflects companies that have a relatively low price for their earnings or their book value, and growth are the ones that are more expensive. So if you take a look at where we are today, this is what you see relative to long-term average. In yellow, you have growth. So I don't know exactly where the average would be, but my sense it would be somewhere around here, maybe a little bit below here. I should have probably put at some point the average. And where we are today is certainly exactly to the point that he made. It is from a book to market perspective, which is a price to book, which is how much does it cost you? How much are you paying to buy $1 of book value? It's certainly expensive when you look at growth stocks. So these growth stocks are certainly expensive. Again, just visually, it seems it's a little bit to some degree in large growth similar to what we've seen maybe in the 90s. The problem is that you have no idea how long this can last. But what's remarkable is in blue here, in teal, you have value. And what you see is that from a valuation perspective, value has been a lot more stable around its average. So that's kind of the super interesting thing for me. I would not look and say the market as a whole is expensive or not. What I can say from an evidence perspective is that when I look at the price to book, which is a metric of sort of the same thing as price to earnings, what you see is that the growth stocks tend to be above the historical average, where value are a lot closer to the historical average. So not every company in the market is expensive by that metric, the one that he just mentioned. It's just that you have to be more careful and break out the market, and particularly this delineation between value and growth could be very useful. Not all companies are the same. A lot of what you see in the market is driven by large growth. It's the largest part of the market, but you don't have to buy those. As an advisor, what IFA does is kind of reshuffles the deck and emphasizes more some of these lower price to book, some of the better valuation stocks.
Okay, so someone had also asked about crypto.
Yep.
We hear a lot about crypto and Bitcoin. Why don't you give us your spiel on the crypto? Because I know you've got one. I know you've got one.
It's interesting because I went on a hike with my brother-in-law. He's a phenomenally smart guy, nice guy, and I love him to pieces. And he was telling me about, all the money that he's been kind of making and some of his friends are making. And it's very remarkable how much money you can make. It's understandable why you hear something like this. He's like, wow, why am I not in this? Why am I not thinking? So I really had to think through myself, what exactly is crypto? Why, where it came from, and kind of how to think about it. And to begin with, just to kind of, for folks who are not necessarily very familiar, the fundamental idea with cryptocurrency came about 12 years ago when we had the financial crisis, and somebody anonymously had this idea of creating a system where you have a digital currency that is not controlled by any one government. And in order to know how much people have, there was a ledger system that lived on different computers, and that system is called blockchain. And blockchain simply says that the same transaction is written on so many computers that you can't really create fraud. And also said, because the government prints unlimited money, why don't we limit the supply of these coins? And in this case, it's 21 million that are supposed to be issued in Bitcoin. So what's interesting about Bitcoin is it was created to be almost a currency. And if you fast forward 12 years later, the question is Bitcoin a currency? Well, currencies have three characteristics that make them a currency. The first one is it's a store of value, meaning that what you can buy today is roughly the same that you could have bought a month ago and roughly the same that you can buy a month from now. Well, in the case of Bitcoin, it's not unusual to see monthly fluctuations over a month or two of about 40%. That's not store of value. The second one, medium of exchange. What it means, do merchants accept that payment? Very few, if any. I mean, I just don't know many people who would take Bitcoin. And thirdly, is it a unit of account? Are prices quoted in that particular currency? And I'm not familiar exactly with how much is a coffee in crypto, in Bitcoin. So because of these things,
you can buy a Tesla, Apollo.
They say you can buy a Tesla, but it's a little bit, I've never heard of anybody buy. I know they bought themselves a lot of Bitcoin, right, which is a little surprising for me because Tesla is supposed to be this environmentally friendly company, and Bitcoin is probably, from an environmental perspective, it's a bit of a disaster. It uses more electricity than the entire country of Netherlands or Argentina to maintain the system. It's very energy intensive, and it's a different story. But to me, I was surprised that. But you couldn't buy a coffee right now because the transaction cost of the coffee itself would be greater than the coffee that you buy. The transaction cost would be greater than the coffee. But here's the deal. The way I think about this is that, and this is something that IFA and Dimensional have in common, this idea of markets and believing in markets. And when you think of stocks, bonds, and real estate for that matter, what gives us all the idea is that there's a market that's trying to create a value, there's a way to value and have a valuation formula for these assets. For stocks, if you are an owner in a company, you can look at the cash flows you expect to get and discount them back and say, well, that's how much I should pay. So I can figure out the valuation of a company based on what I expect to pay. And the company would have real people, real profits, real products. Bonds, you receive interest payments, you can value how much is that worth it. Real estate, you buy the building, collect rent. Okay, this is how much it's worth it. So this idea, these are productive assets that have a way of being valued. Bitcoin has none of that. It doesn't pay interest. It doesn't produce anything. So it's impossible to value. It's if it's $60,000 or $60, I couldn't tell you if it's a good deal or not because there's nothing to value that. People buy it hoping that somebody else will pay more for it. But why? Nobody can tell you why. So in that respect, it's not really an investment as much as of a bit of speculation. So because of that, I don't think right now Bitcoin it can really help a financial plan because if you look at all the fortunes that you can make with Bitcoin, I also invite you to think of all the money you could be losing with Bitcoin. And is that really helping your financial goals? I found that it's not necessarily. On top of that, Mark, there are some real logistical issues, which is the fact that you only have a digital wallet that's on your computer. If that hard drive crashes, or if you forget the password, then the money's gone. There was a story in the New York Times not too long ago about somebody with $200 million in Bitcoin. They had 10 tries to put in the password, and after the 10th one, the money was locked up forever. You can't call a bank and say, hey, what's my password? That's gone. That's gone. So, how many of us have not lost a password? And then you have tax issues. And so it's pretty complex, plus fraud. Let's not talk about fraud. And on top of that, pile more on. Bitcoin is one of the few thousand cryptocurrencies that exist right now. And it's really unclear which one will be left standing. There was a piece of digital art called non-fungible tokens that was purchased just about a month ago, I think, for $69 million. And the transaction is written in blockchain because blockchain does have phenomenal application. You know what the thing is? It was not paid in Bitcoin. It was paid in a competitor cryptocurrency called Ethereum. So is it possible that maybe some cryptocurrency might take hold, but it might not be Bitcoin? Is it possible that the government might actually have a sanctioned cryptocurrency competing with Bitcoin? How would that play out? So we can talk about a host of other issues, but ultimately I have to ask a question for everybody. And I looked at myself and I asked, why would I want to have crypto? Well, because I understand that I can make a lot of money. I understand I can lose a lot of money. So there's a very big risk involved. And why would I want to do that? And what I found is that, to me, at least, it wasn't because it helps my financial future. I don't want to put enough money there to actually impact my wealth significantly, but it was because if I ever considered it, it was almost like a substitute to a trip to Vegas during the pandemic. I just want something to watch and feel good about owning or not owning. And if I lose that money, so be it. It's just a little change there. So more like sandbox money. And why you want to own it, it's really important. But to me right now, I don't see any compelling evidence to say investors, you should pile all into or go into Bitcoin. On the contrary, I say you should be you should be paying attention to these considerations because they're real. And at this point, I don't believe that Bitcoin has a compelling case to be part of somebody's allocation.
So the other thing, Apollo, the IRS has now said if you bought your Bitcoin at 40,000 and then you go buy a Tesla when your Bitcoin is 50,000,
of course
you're going to pay a capital gains tax on that $10,000 change in value, which solidifies this as not being a currency but a commodity.
It's a commodity. That's exactly how the IRS defines it, as a commodity.
That's right.
And
so what I always tell people,
be careful. Be careful.
What I always tell people about gold and silver is they don't make a profit. So to value them is very complicated. And if you had a bar of gold from 1929, a bar of gold today, it's exactly the same. You want companies that grow and make profits. That's one of the big drivers. Okay, one more thing I want to cover. We're just a couple of minutes over time here, and that is the conversion of these tax managed funds into ETFs. That's going to happen on June 11. For those on the call, if you haven't seen our article on this, published on April 7th, and so you can go back and read that. But give us your thoughts and the reasons behind this conversion.
Yeah. So back in, I'm not going to go all the way in the history, but back in 1940, this idea was that if you have a need to be invested, most investors, first of all, don't have the level of assets to be properly diversified in many, many stocks. So this idea of when we commingle some assets, so a lot of the investors put money in, and then when you put them together, there's a larger pool of money that allows to buy a variety of stocks. And on top of that, if you add some professional management, that should also be a positive for investors. So in the 1940s, we had an act that created this idea of mutual funds the way they are today. And in the world of mutual funds, people put money together. And if investors want money back, the mutual fund would sell the securities, would get the cash, and then give it to investors. If investors put money in, then the fund would buy more shares, and the fund would get larger. So that's been what's been available to investors for, since the 1940s. Now, over the past 10, 20 years, there's a new type of structure around exactly the same idea. So the idea is exactly the same. A lot of investors are pulling money in, but the structure now was a little bit different. And it was this idea of an exchange traded fund, or ETF. And the idea of the ETF was that if you know a particular basket of stocks, and everybody knows what's in that particular fund, instead of raising cash by selling securities, which creates a taxable transaction, perhaps these ETFs can exchange with another institution in a way that mitigates some of these tax issues. And mitigate meaning they delay the taxes, not eliminate, but delay the taxes. So, what we've seen over the past few years is that the regulations have changed, and now this type of investment ETF, the exchange traded fund, which used to be applied only to purely conventional index funds, is now available to a different type that is not necessarily tied into a traditional index fund like before. And what we've seen at Dimensional is that mutual funds can work really well, and they have great advantages. For some taxable investors, this idea is that we already do some things in the mutual funds, but is there a way that the ETF can add another layer to what's already there? And that's kind of why we start considering this idea of a conversion, because you can do exactly the same thing. You take exactly the Gamestop sets, you just change the wrapper, and now it allows us to do one more thing that we couldn't do before. And this is not, again, eliminating tax. I want to be very clear. This is about delaying taxes down the road. And the way that I think about the distinction between ETFs and mutual funds, it's really more of you have a Harry Potter book, and you can either buy the hardcover or you can buy the paperback. The content is the same. The wrapper is different. So what's really important is not the wrapper, the way it looks, is what's inside. And when it comes to this, the strategy is exactly the same. It's just now we have one additional tool that we didn't have. And because of that, we thought that we owe it to investors who are looking at these tax managed funds for more tax efficiency to make this conversion. Now, at least the expectation right now is that it will not create a taxable event. So it doesn't mean that when you wake up on a certain day, and instead of that particular mutual fund, you now have almost like an equivalent, a similar investment in the ETF. There will be a taxable event, meaning that you haven't liquidated that. It's just basically you're going to have a different ticker. But in terms of the strategy, in terms of the content of the fund, that's not going to be any different. So it's just another layer. And we thought this is absolutely is doing the right thing for the clients.
There was one other thing I just wanted to mention. When people were talking about fears of inflation, fears of PE, basically what I like to lump together is uncertainty, okay? This is basically the uncertainty of your expected return. When you add all of these uncertainties in here, oh my gosh, what should I do? Well, the answer is that the price is already adjusting to these uncertainties. And the uncertainty is the reason you get a return. Right. If things were all certain, why should you get a return for holding the return, a security that's certain? I can give you the answer. If you own a 30-day T-bill, it's very certain that you will get your money in 30 days and your small amount of interest, but you're only going to get a return that's close to inflation. Basically, it's zero risk, zero return net of inflation. Maybe they give you a little bit more, but I want people to learn to accept uncertainty and basically to bear it. And in fact, the more you can handle, the higher your expected returns are. And all you have to do is look at the history, the higher the past returns have been. And I even hear people saying, oh, America, it's really, going to hell in a handbasket. I'll just throw it out there. What's going to happen to America? Well, the riskier America becomes, the higher their returns need to be for people to hold their securities. So I don't want you to be concerned about risk. I want you to accept an appropriate amount of it for you. And that's what our risk capacity survey is all about. How much can you handle in a loss in a 12-month period, for example? What's your income look like? What's your net worth look like? And really important, what's your knowledge about the way markets work? And that's what we've contributed to today. Thank you, Apollo.
Mark, thank you. I couldn't have said any better. Thank you so much for inviting me again and inviting us at Dimensional. It's such a not just fun, but it's a joy to talk to you and do these town halls. So I look forward to the next one.
It's a little bit of the mutual admiration society here, but that's okay. You all have a great weekend and a great day. And we'll see you, at least Apollo and I together. We're going to continue to do this on a quarterly basis as long as we can. And we look forward to seeing you next time. And Chris, thank you for your little history on Dimensional today. That was great. And Kenny, thank you for answering some of those questions. I saw that you did that. So see you later.